Hello, everybody. Hello, and welcome to Private Equity Rundown. I am Bill, the company's expert. What a hectic day. I was about to sign on, and I discovered to my horror that the screen resolution of my streaming application managed to change itself. So I had to troubleshoot that at the 11th hour. Always a fun thing. Thank you for joining me today. This is the weekly live stream where we talk about private equity and all things business or higher level business, as opposed to the other stream I do every week called Side Hustle Ideas, where we talk about sort of business on the small scale. So this is episode 6 of Private Equity Rundown, and the title of this episode is called The Audit Committee Explained: What it does and why it matters. So extremely exciting stuff here. We are continuing our exploration of the structure of private companies, and this is sort of the next chapter in that. We talked about the board of directors, we talked about the compensation committee, and today we're talking about the audit committee. And next week, because of popular demand from a viewer, we are going to take a bit of a detour. We're going to talk about options and derivatives. So I figured it might be fun just to do that. And then we're going to come back and we're going to talk about private equity in itself. So thank you for joining me. I see there's 10 people today, 12 people here. Thank you. Let's dive right into this. Okay. And as always, as you can see on my screen, if you want to learn business, check out my $100 MBA course. Best bang for the buck around. Okay, now, what does an audit committee do? Well, as we've established previously, okay, the structure of a company, you got the CEO as the most senior manager running the organization, not necessarily owning it, but certainly running it, managing it, okay, usually on behalf of the owners. And then they report to a board, the board of directors, and the directors are sort of hand-picked shareholders, usually in private corporations. And just so everybody knows, we're talking in this live stream, we're talking mainly about private companies, not public companies. And we're talking about private companies that are of a certain size, usually between, I guess, technically $1 million, all the way up to about $30 million annual revenue, certainly. That's the kind of stuff that I have experience with, so that's what I'm talking about. Obviously, this stuff is going to vary if you are talking about public companies. It gets, there's even more details and more things you got to do for public companies. And it's obviously going to vary if you're talking about different countries. So I'm talking generally about this stuff. Usually where I am in Canada, it's pretty similar to the United States. There are some differences, and it's going to be a little bit different from the EU, but the general principles are pretty much the same. So they go kind of across the board. Okay, so we talked about the CEO and the board of directors. Now, the board of directors that represents the shareholders, okay, if they're not one in the same in a private company, they can have different committees, right? We already talked about the compensation committee. This is kind of a subset of the board of directors, and they decide how the CEO and the senior management are compensated, and if they're doing their job properly, and if they're not, what to do about it. So that's a subset. The audit committee, what we're talking about today, this is another subset of the board of directors, okay? And the reason why you have this is because basically it's triggered by legislation, okay? So if you incorporate your company, whether you're incorporating it nationally or provincially or by state like they do in the US, you have to conform to different laws. There's different requirements for what you need to show. Now, for public companies, there's a lot more rules, right? For private companies, there's less rules, but there's still rules. Usually it says that you have to have some kind of audit committee. And that's usually, for smaller private companies, as deep as it goes. Then, if you consult the company's own articles of incorporation, it might give you a little more detail on the audit committee or in the board of directors, how it's going to work, like who is allowed to be on the audit committee, things like that. And then if you go to the company's bylaws, where it specifies a lot more details about things that are going to be done, especially governance, it goes into a lot of the nitty-gritty details of precisely how they're going to do an audit committee. So you got those three things sort of in order of seniority, as it were, bearing down on you. There's the law of the land, the legislation, usually in some form of Corporations Act. Then you've got the Articles of Incorporation. Then you've got the company bylaws. And those three things will lay out some guidelines of how you're going to do an audit committee, okay? Who's going to be on it, what their roles are, what qualifications they need to have, and what are some things, some hoops you have to jump through in terms of if you have to hire external people that will be involved. And that's definitely a part of this, okay? So the audit committee, its purpose is to maintain the financial integrity of the company, okay? Make sure that it maintains compliance with legislation, number one, and accounting practices, number two, okay? So when you release financial statements, even if it just goes to the directors or the shareholders, that they're accurate and they're done according to accounting standards like GAAP, like GAAP, generally accepted accounting principles or practices. Okay, so that's its purpose. Now, the audit committee, it deals with internal audits and it deals with external audits. Hopefully everybody knows what an audit is. That's when you check to make sure that something is being done the way it's supposed to be done, right? So these involve mainly financial auditing, so you get a team of accountants in there doing this, okay? Both internally to the company, meaning that the company's own employees that might be qualified accountants are going to do an internal audit. So they look at their own practices to do with the financials and the reporting, but they also look at other things too, okay? It's not just limited to verifying transactions, which is kind of what you might think. If you send in an army of auditors, right? They're going to go in there and they're going to like look at the books, right? They don't just look at bank records and they look at internal transactions and see where the money flowed. That's kind of where it starts, but they're looking at a lot more than that, okay? So you can kind of break this down and say that every once in a while, the company's going to do an internal audit. Okay, so we get our own employees to just verify that we're doing things properly when it comes to financial reporting. Okay, and but not only that, we're also going to expand what we're checking up on to include not purely financial stuff, but to do with things that involve like risk management and processes. Okay, we're going to be doing all of that. And then the audit committee, one of their duties is to get in external auditors. So that means that usually what ends up happening is the company hires an outside accounting firm, usually one of the big four, right? My background, I've dealt extensively with PwC, PricewaterhouseCoopers, and what you do is you basically engage them to come in and audit your books for you, and not just your books, but all your processes, okay? So what you get is you get a sort of internal investigation, the internal audit, and then you get an external audit provided by independent people that will independently verify that what you say is going on is indeed going on. That's how that works. So the audit committee is like a bridge between the auditors, whether they're internal auditors or external auditors, and the board of directors. That's kind of what it does. So all the auditors report to it. Okay. The audit committee usually meets every quarter, and sometimes more often if there are specific issues to address. And the audit committee will consist of some directors, a subset of the board of directors, maybe a couple of people on the board of directors that are financially literate. Okay, they have like maybe a background in finance or accounting. There will also be other people that attend those meetings, like if you have a CFO, or you don't have a CFO, but you've got like a senior sort of accountant. So you could call them a controller, because that's kind of what they do. They're just basically an accountant. They're not really doing strategic finance. You're not that big, you know. But your senior financial person will be there, and your external auditors would be there too. Okay. And as I said, you've got the purpose of this is, number one, to review the financial statements, right? And other disclosures, financial disclosures you might have. Secondly, you're going to be looking at internal controls. This was the other things I was talking about. So instead of just looking at, your financial statements, which are based on financial transactions, you're looking at how the business is run. So for example, who has the authority to approve different expenditures, for example? Can employees just spend company money on a whim? Do they need approvals? Like, what is the system? Is it what it should be? And is it being followed, right? These are some of the things that the auditors would be looking at also. So technically that stuff isn't technically financial. It's more like processes, internal processes. They're looking at that stuff too. And this involves knowledge of risk management. I probably should have done a better job of trying to plan this out because I'm going in all these different directions at once. We're going to talk about risk management a little bit later, what it is. But we're talking about what the purpose of the committee is. Number one, it's to review the financials. Number two, to look at the internal processes and controls. And number three, it's to oversee the external audit, right? So in terms of who you hire, which firm you hire to come in and do an external audit, the audit committee decides that. They decide how they're compensated, and they determine if these people are independent, which they should be. They shouldn't have any conflicts of interest, right? And then after the external audit is done, the external auditors, whether it's PwC or any other accountant, they will present an audit report to the audit committee and say, this is what we found. This is, our recommendations. Okay. Yeah, I need to do better notes for this. I'm just sort of writing down stuff. Hopefully everybody knows what financial statements are. We haven't really covered that here. Basically, there's 4 financial statements that are of prime importance for any company, any organization. And I'm not an accountant. I'm a finance guy, but the 4 financial statements are the income statement, the balance sheet, the statement of cash flows, and the statement of retained earnings. And in my experience, something that the audit committee will pay a little more attention to is the statement of retained earnings, because that's obviously where the statement of retained earnings is basically what the company does with its profit. Okay, that's what that statement basically is. You could pay it out to the owners of the company in the form of dividends, or you could reinvest it into the company if you choose to do that, which you probably should to a degree. So it sort of tracks that. All the other financial statements, they kind of lead up to determining essentially if you've made any money, and then the statement of retained earnings says what you do with that money. That's kind of the idea, right? So they will be discussing that too as part of it. I don't know what else, where I should go with this. We talked about, let's see here, I'm going to jump around a bit. We talked a little about risk management. If you've never heard of risk management, this is something that I had to learn separately many years ago. It's kind of a weird, eclectic kind of thing here, where it's like a lot of different areas. I'm just distracted by the comment there that somebody wrote. Yes, I have no doubt you're right. I had some technical problems at the beginning of this live stream, and it looked like I fixed it, but obviously more stuff has been corrupted, and the stream is the wrong shape or whatever. So I'll get that fixed. I have to dive into it afterwards. Anyway, so risk management is this interesting field. It's like an interdisciplinary field. It involves some financial stuff. It involves like insurance and finance and all that. But it also involves operations and IT and HR and more strategic sort of thinking. It's a lot of different fields kind of all in one, because you're thinking of all the risks that you could be exposed to as a company, right? And there's all different kinds of risks in all different areas, and you have to sort of like talk about them all at once So it's kind of an interesting field because you need people that are experts in all these different areas, right? Like, for example, some common risks are risks in terms of compliance, right? There are legal requirements for the company to operate, and the laws govern many different things. And, if you are in danger of violating the laws, that could require corrections in a lot of different areas. It also requires someone to be familiar with laws and be familiar with what's going on in the company, right? Technology is another major risk, like cybersecurity and, privacy and all this kind of stuff. That's a major risk. You need people that have expertise in IT, but also understand business flows and stuff like this, and risk assessment. Strategic risks, if the company is making the wrong strategic decisions, they're getting into markets that, are declining and that you can't make money in them, like you'd have to evaluate those kind of strategic decisions too. So that's a whole other area too. And then you have to translate that in terms of like, how much money could you lose and things like this. So as you can appreciate, a lot of different skills required to do this. Obviously, financial skills. So you have to be financially literate, because depending on what you're doing with your finances, that in itself could be a risk. Like if you take out a lot of debt and all of a sudden interest rates go up or something, and then that's it, you can't cover your debt. So it could be purely financial. Operational risk, like if you are, dealing with inventory and stuff like this, and you're not locking your warehouse when everybody goes home at the end of the day, like things like that. I mean, that's a part of it. It's not something you can see by just looking at financial statements. You'd have to actually go and take a walk around of your facility and know what to look for. So many different areas. Okay, so you've got all these different types of risks, and what they do in risk management is they try and identify the different risks, assess them, quantize them, right? Figure out what you can do to mitigate them, make recommendations, implement plans, and then monitor how effective the fixes or the mitigation efforts were on an ongoing basis. So it's very complex, that field. And obviously, if you're dealing with smaller companies, you can't just employ 1,000 people to do risk management. You have to do almost a subset of it. So the real questions lie on where should your efforts go. If you can only say hire 3 people to deal with this or something, depending on the size of your company, where should their expertise be, and should you get external people and all this kind of stuff. So this all falls under the audit committee, because ultimately the audit committee has a responsibility for ensuring that everything is compliant and that there's integrity in all your processes, and things like fraud and stuff like that can't easily happen. And all kinds of legal liabilities can't just all of a sudden end your business operation. So this all falls under the purview of the audit committee. And this is how they manage to handle all of that. They have internal audits, and then they also mainly do it through external audits, but they have to oversee the external audit since they're ultimately responsible. Okay, I think that's probably a good overview. I think I touched on very briefly, if you have a CFO or a controller. Some companies, you really don't need a CEO in the traditional sense. It's not really a strategic kind of thing. You basically need a jumped up accountant, right? So in my experience, what you would have is you wouldn't really have a CEO until you hit like a certain amount of revenue, maybe like, I don't know, $20 million of revenue or somewhere in there. Below that, you've essentially got a controller. So you hire someone who's an accountant, who can do all your financial statements, can do internal auditing. They also can manage, sort of very basic like IT functions and HR functions, all in sort of one role. That's what I've seen before a couple of times that I'm familiar with and that I think works well. When you get into having an actual CFO, you're dealing more with like the treasury sort of function, where you're looking at raising capital. You're more capital intensive, so your margins may be a lot narrower. So precise controlling and management of a lot of operations and things is much more important because the margins are very thin. And sort of getting like financial efficiencies become really, really important, where you'd want to get that done right by throwing more employees at the problem. So, if you're wondering about what the optimal capital structure is and all this kind of stuff, you get more of a CFO type in there, and this sort of thing. Obviously, if you're in like a sort of financial services type area, you'd have a CFO, but if you're in just sort of other industries, then you probably wouldn't until you grow a bit bigger. So there you go. Okay, let's go over to you guys here. Thank you to NevFS for pointing out some technical issues that I still have. I had to install some older software on this computer, and then I think it messed up a lot of settings and things, so I will have to look at that. Get to know your space facts is here. It says, if I want to excel in corporate environment of construction industry with business degree but not an engineering degree as an office administrator, which skills should I learn and how? I just did a screening interview. Okay. Listen, I could give you my opinion on that, but my opinion really doesn't matter because the answer to that is going to vary. First of all, depending on what industry you're in, where you are, what type of construction, and a lot of other details. So what I'd highly recommend to you is what I recommend to a lot of people is get that question answered straight from the horse's mouth. So who would know this? Well, probably people who are working as office administrators now in construction businesses, the kind that you aspire to work at, okay? They would probably be able to talk your ear off all about this and give you very, very precise information. So that would be the ultimate source of this. So what you would do, this would be my recommendation. This is what I found is always the easiest thing to do for answering this kind of thing. First of all, go to go to LinkedIn, okay, and do a people search for office administrator, if that's what you're wondering about, and then limit it to your hometown and limit it to the construction industry, okay? So this is a people search in the construction industry in your hometown or your town where you're looking to get a job, obviously, okay? And then the results are going to be a whole bunch of individuals, okay? You're going to get a list of people. And now that the first thing you can do is you can go and look at their profiles, right? So if you're wondering, like you said here, you want to excel as an office administrator. What skills should I learn? So look at these people's profiles. There'll be a lot of people results. These will be people that are either working right now as office administrators in the construction industry where you are, or they're former employees. They used to work in this role in your industry right where you are. Okay? Now, look at what their profile is, essentially their resume. So look at what's on their resume. What skills do they have? What is their background? Did they get that job right out of school? Or did they get that job right out of working for 25 years in the business, doing a specific role? That will inform you of what you're most likely going to need or be expected to have, okay? So for example, if they all have a certain certificate in something, then chances are you'll be expected to also have that certificate if you want that job. If none of them have that certificate, then chances are they won't expect you to have it. They won't need you to have it, right? And so on. And that also applies with experiences. So first you can do this, okay? And you can get the answer to this like in 15 minutes, okay? You could do this right now and get the answer. If you really want to go above and beyond and get even more detail, you could then reach out to some of these people. You could send them a message, a DM, or you could try and connect with them, depending on what time frame you have for this. And then if they respond, you can say, I'd very much like to speak with you, for, say, if you could spare me 30 minutes or less, I'd just like to ask you a few questions about, your experiences in this role. I'm looking to get into that, and I'm just wondering if I could pick your brain about, skills and how that industry kind of works, or what's involved in the role, something like that. And, if you blast this out to a lot of different people, most of them won't respond, but some people will. And some people will say, sure, I have no problem talking to you. Here's my phone number. Give me a call. And then you could speak to them directly and say, I'm looking to do this. What would you say is the answer to this? And that's how you can get that information. Does that make sense? Hopefully it does. So, yeah. Yeah, so there you go. Anyway, we did an overview of the audit committee, which is another major part of the corporate structure. As I said earlier, next week we're going to do a sort of almost one-off topic because somebody wanted to know a little bit more about options. We had been talking about executive compensation and how you can compensate people with not just shares, but with options on shares. And so I'll be happy to go into a much more coherent, deeper dive into that. We're going to talk about that next week. And we're also going to extend the discussion to different types of financial derivatives, because options are one type of derivative. They come into the discussion when you're talking about compensation. The other ones usually don't. The other ones are used for other things. But it's a good thing to know. The other thing about options is that it goes into things called real options, where, if you're talking about like a plan, right? Like, for example, say you're building a house and, you can build a house and you can do the foundation and the framing and all that. You could do like the bare minimum you would need, right? But maybe there's something you could do while you're building the house, like maybe something to do with the foundation. You could, I don't know, make the foundation deeper or more capable of supporting more weight or something. And it would only cost you like a pittance to do it while you're doing the foundation. You just add more concrete or something. But let's pretend that you finished the entire house, and then 5 years later, somebody wanted to upgrade the house and add a second story or something. Now, in order to beef up the foundation, it's something like 20 times the cost doing it then than if you had done that while you were pouring the initial foundation. You know what I'm saying? So if you decided when you're building the house, should I make the foundation better than what I need or just do the bare minimum? That decision, that's called a real option. You have an option to do something in reality. That's why it's real. That will cost you money up front, but it gives you the option of doing something later on where you would have saved a lot of money, right? So the cool thing about options is it doesn't just apply to purely financial things. It applies to real life stuff too. So you can place values on like real decisions, stuff like that. We're going to get into that next week. Other than that, I'm going to wrap this up in a minute. So I see there's 17 people here. Thank you for joining me. Sorry for the weird time slot this week. I had some technical issues, and I still have some technical issues that I got to deal with. So I will take care of those. But just as a reminder, if you want to learn business, this is the best way to do it. I have a course called the $100 MBA. I have an MBA myself. And although it's a course, it's technically a program because you're learning many, many different subjects in it. You're learning the same material that you would learn in an MBA that you would take at brick and mortar university. So you're learning marketing, operations, finance, accounting, HR, organizational theory, economics, innovation, all that kind of stuff all together, right? Now, if you just are interested in one of those topics or a subset of those, that's perfectly fine. If you just want to skim the material and get a basic understanding of it, but you don't want to go in depth, that's perfectly fine. If you wanted to go in depth with all the material, all the different subjects, you can certainly do that, and that's where it's the equivalent of an MBA. The catch is that it's self-study, You're getting textbooks. You're reading the textbooks. I'm guiding you through the textbooks with videos, but you have to do the work. And you're using the same textbooks that they use in places like Harvard Business School in their MBA program. So, you're getting that same result for a tiny fraction of the price. So that's the idea, and it's super flexible. So check that out. And I will be back next week at the proper time, an hour earlier than we started today, with another episode of Private Equity Rundown. Thank you for joining me. You guys take care.